Just double checking some things here. Okay, so I got my stream going in one ear, I got Discord going in another, and then I got, okay, characteristics of log normal distribution.
Well, I'm not here to validate or not, but I think you'll probably be able to find validation, right? I just want to describe, in the Black-Scholes model, which is really, at its base, the model itself is just a description about how underlyings move. Okay. Right? It says that the returns, the logarithm of the returns are normally distributed, or move in random steps. Okay. Right? And the Black-Scholes model says it's by Brownian motion. The binomial pricing model uses them as random steps, but because simple random walk converts to Brownian motion in the limit,
they look the same.
These are almost like these are sort of morally equivalent. A quick time looking binomial pricing model is the same model for the underlying price motions as the Black-Scholes model. It just, you have to go through the binomial thing is one of the ways to introduce an American pricing into the Black-Scholes formula.
Because otherwise the morally equivalent?
Oh, that's a bad mathematician habit, yeah. I'm sorry. That's something I used to get.
We like to have very little moral while we hear, okay?
I just no, I'm sorry. That is an actual thing that professors of mathematics say that I am annoyed about.
It's like if you registered, you have to say typically. Yeah. Typically, this will happen.
Yeah.
Mm-hmm. Yeah, I love that. I don't think I've ever heard that before. It's morally equivalent when comparing the Black-Scholes to the binomial models.
Actually, so this is maybe right. If someone tries to tell you that there's something very different between something that happening very.
One of the first things I learned we were building Thinkorswim was TP was building was helping the developers work on some little tweaks to some proprietary models for Black-Scholes and for binomial. Mm-hmm. And there was also one other one on there. The what's the other one? The Burke.
Heston.
No. What is it? I can't remember.
Berksud Stenslin?
Oh, I don't know that one very well.
Okay.
BJER?
Yeah, whatever it was. There was the third one. This is going back into TP's a lot older. So I go to him, I looked at him one day, I go, hey, just for argument's sakes, are these in here for marketing purposes, or is there a big difference between the three? He goes, you can't tell the difference.
Yeah.
Okay, good. He looks at me and goes, you can't tell the difference. He goes, you can never figure out the difference in 100 years.
Well, I'm right, and one of the reasons you almost definitely can't figure out the difference, because unlike, physics where you write down an equation and you think, I think baseballs fly like this, and someone else writes down a different equation and says, I think baseballs fly like this, and then you watch how baseballs fly. The equations you wrote down don't move the baseballs.
Of course.
But in the market, the formulas that you use move the market.
Of course.
Like once everyone is on board, that starts affecting itself. So it really is sort of
itself, right?
Right. It sort of is impossible to distinguish what the true model for the thing is, because how we are viewing it changes how they move.
Before the formula, Black-Scholes is really a model for how prices of underlyings move. The formula is then just the fair price for options on underlyings that move like that, provided the market is frictionless and arbitrage free.
Right, and those are the two sort of damning assumptions, or the places look for inefficiencies or something.
Exactly. Exactly, because, and the reason he says frictionless and arbitrage free is because sometimes, and this is going back to stuff that doesn't exist today, but before the marketplace was supported by the technology to support today, it was possible to have, a market where you could actually arb like products.
Yeah.
I don't think that exists today. The technology is too fast.
Well, right, where the moment that there is such a thing, it disappears into someone other than you got
in
it.
a millisecond.
Right.
No, I understand.
Frictionless, though, it isn't frictionless. Right, frictionless is commission costs and cost of carry and hold, and all of these things are friction.
Yeah. The cool thing is that it's where there's friction, there's usually price compression. Mm-hmm. One of the things that's confused me for a long time is Vegas. Can I talk about this for just 1 second?
Sure. It's fun and exciting.
Love how Tom starts talking about Vegas.
Need to know. Okay. Fun and exciting, but isn't it so interesting to you that they keep trying to sell fun and exciting as opposed to compressing their margins to attract gamblers?
So, but they don't want rational gamblers. That's not the objective of running a casino.
I'm not talking. There's plenty of irrational.
Why break the model? It works so well.
Because it doesn't. Because they don't get that much money. There's not that much money at play.
The building big
I
places.
understand, but there's less money at play now.
Than in the market.
I'm wondering why Vegas doesn't why Vegas is one of those businesses where, like you said, there's a frictional. Is that the word? I don't know. There's
Frictive?
There's a frictive.
I think it's frictive. Frictive is
There's
a word.
a
I don't know what it means.
component
Linguistic term.
to a mathematical equation, which allows it to be compressed, which would, for me, be a monster marketing idea. Yet none of these people do it. I don't understand that, but we'll talk about that. It's an experiment off of this. So what does the Black-Scholes model say about the price of underlyings?
Right, so the Black-Scholes model just sort of begins with the assumption that the logarithm of the returns will move like a random walk or like a Brownian motion, right? And again, I'm going to say morally equivalent,
Yeah.
Right?
I think I need to get my desktop computer to be able to do all this at
but
once.
this motion happens in the logarithm space, and so that means that it's e to the that, right? E to a Brownian motion is a geometric Brownian motion, or the other way to think of this is that if it's a Brownian motion, what your logarithm returns are, well, then that means at any specific time, you get a normal distribution, because that's what makes Brownian motions Brownian motions. That's one of the things about Brownian motions, is that if you pick a time and then look at a Brownian motion, what you get is a normal distribution.
Got it.
Right, and with just a standard deviation increasing like the square root of time, and the mean moving like the drift times time. That's what a Brownian motion is. And so if you are cutting them off into normal distributions, then what you wind up with are e to normal distributions. And e to normal distributions are what are called log normally distributed. And so we want to then, if we go forward a couple of slides, we'll start talking about how the properties of this normal distribution up here affect the log normal distribution down there.
So the difference between a normal distribution and a log normal distribution is the log normal distribution will look different at the tail end.
It'll look different on both. It looks kind of similar right in the middle.
Of course,
like their bulks do look similar because the derivative of e at 0 is 1.
Oh god, that's the math part. Got it.
Right, they're linearly related to each other. They're tangents of the same right there.
Oh, you're gonna throw math into this?
Yeah.
Well, that
is the title of the segment.
It asserts that, viewed discretely, the logarithm of returns will follow a random walk. How do you define random walk?
So state space and a discrete time variable, and usually we define it by like transition probabilities, but in general it's just defined by at each time you have a probability from each space, you have a probability of going to each of the other spaces, and that's sort of the discrete finite version, and then you scale and continuize it if you want to.
Cool. So as you make a simple random walk.
So that part right there, even the random walk, and how at each step there's an equal probability of going into each space, or of each other space. That right there is something to think about, and these things take time to really understand fully, not fully, but just even conceptually, and that's what we're gonna do here. Is we're gonna take time to learn these things, and we have the tools to be able to put them into practice. So just even thinking about that, we'll replay it. You know, sometimes it takes a couple of times to be able to really understand what Jacob's saying, and conceptualize.
In general, is that you have a state space and a discrete time variable, and usually we define it by like transition probabilities, but in general it's just defined by at each time you have a probability from each space, you have a probability of going to each of the other spaces, and that's sort of the discrete finite version, and then you scale and continuize it if you want to.
Cool. So as you make a simple random walk finer and finer, that is, you shrink the step sizes and appropriately increase the rate at which the steps are taken.
Right.
This increases the Brownian motion.
A more direct definition for random walk is it's a series of plus minus 1 coin flips. So first it's 0, and then it's either 1 or minus 1, and then it goes up by 1 or minus 1 just every time. That's the simple random walk on the integers, which is, and the shrinking step sizes means instead of going plus minus 1, I'll go plus minus a little bit.
Yeah.
But then if I want to get anywhere, I have to start taking steps faster.
Got it.
And the ratio is a square, or the proportionality is a square. This is the square root is the square root of t that's always around.
This will limit why the binomial pricing model and the Black-Scholes models are so.
in a discrete time variable, and usually we define it by like transition probabilities, but in general it's just defined by at each time you have a probability from each space, you have a probability of going to each of the other spaces, and that's sort of the discrete finite version, and then you scale and continuize it if you want to.
Cool. So as you make a simple random walk finer and finer, that is, you shrink the step sizes and appropriately increase the rate at which the steps are taken.
Right. So
this increases the Brownian motion.
A more direct definition for random walk is it's a series of plus minus one coin flips.
Random walk, a series of plus or minus coin flips. So very similar to positive or negative returns with the stock market or in stocks as well.
So, first it's 0, and then it's either 1 or minus 1, and then it goes up by 1 or minus 1 just every time. That's the simple random walk on the integers, which is, and the shrinking step sizes means, okay, instead of going plus minus 1, I'll go plus minus, a little bit.
Yeah.
But then if I want to get anywhere, I have to start taking steps faster. And the ratio is a square, or the proportionality is a square.
So thinking about that random walk.
The square root is, this is the square root of t that's always around.
This will limit why the binomial pricing model and the Black-Scholes
Series of positive or negative returns.
So here, all right, now take us through this, because this is where I start to get confused with all the...
All right. So this is the key property of Brownian motion, which is that Brownian motion has two parameters. One is drift, which is just the direction that it's generally going, and the other is its infinitesimal variance, which is how wiggly it is, right? Or it's the volatility squared. For log returns, volatility squared is variance.
Okay.
Or infinitesimal variance. So that makes it that for any fixed t, when you look at the Brownian motion, what you get is a normal distribution, where the mean of the normal distribution moves along by the drift all the time, and the variance of the standard deviation of the normal distribution increases outwards, but only like the square root of time.
Okay, so what are the differences between these lines, these colors?
Right, so it's over on the top right is also the labels for these. I credit where credit's due. These pictures are pulled from Wikipedia, I guess. The mean is done with the mu, and the variance is done with the sigma or squared, and then it's graphs of the probability distribution. So that's the probability under the area under each of those curves is the probability of a normal random variable with that prescribed mu and sigma landing in that range, right? And the range it's centered at 0 and goes out to plus minus 5, but really goes out to plus minus infinity. It just has these very narrow tails, right? These exponentially decaying tails of a normal distribution.
I like
Sure.
that. No, I like it. Okay. So what do we have here?
Which is why we don't assume a normal distribution for finance, because there aren't the tails are actually for assets for a lot of different assets, but in particular like the S&P 500, their tails are actually wider. That those events happen more often than a normal distribution would prescribe.
Right, well, since we've said that the logarithm of the returns, which is log st over s0, which sometimes will get written as log st minus log s0, which is just a thing about logarithms,
okay.
Right? That division becomes subtraction. But for any specific t, log st over s0 is normally distributed because all of the this is what we were just talking about, because it's a Brownian motion and it's a specific t. So that quantity, log of the current price.
If you say okay right now, I'm going to jump over my desk.
Well, I'm not prepared to argue this right here.
You're not prepared to argue this?
I'm not prepared.
You need a little bit more research?
Yes.
Mm-hmm. The log of the current price divided by the original price looks like a normal distribution. That's all we got to be at a specific time.
We're having burgers for lunch today.
Oh, burgers are delicious.
Okay, and then this is your log normal distribution.
Right, because this is right. St, the thing on the right, just is equal to it if you expand it out for a second.
Right.
But that thing inside the curly braces is a Brownian motion, and therefore for a specific t is normally distributed, and that makes the whole thing look like S0 times e to a normal random variable, and so e to a normal random variable comes out as a log normal random variable, and so over there are now the probability density functions for a log normal random variable, where you can.
So what's my takeaway?
It'd be good to go back and forth between those two slides.
What's my takeaway from this?
So you sort of want to get a feel, in the same way that most people, I think, have had enough exposure to the normal distribution that they sort of have a feel for, like, the center bulk and the tail and, like, being one standard deviation up or two standard deviations up and how rare that is.
But is there something Is there a preference here?
The areas under these bulks look different, except so right in the center it looks similar, but then the tails behave very differently. Right, for one thing, it doesn't go off to negative infinity. It truncates down at zero. The whole narrow tail to negative infinity is collapsed into zero.
Yeah, because it can't go below zero.
Because it can't go below zero, and the positive tail is sort of extended out, and the negative tail is compressed in.
So there's a lot of argument.
So that right there is a lot of the questions in the incubator about how you can get returns or prices like Tesla and Apple and S&P 500 or whatever. It's that this distribution characterizes stock prices much better because it's bound by zero and the means somewhere. It's similar to the normal distribution, but it can go off to infinity. So the normal distribution is saying negative infinity to positive infinity, and the normal the log normal distribution is from 0 to infinity, which is much more like the way that stock prices are designed. And so you would have a much fatter tail in those positive towards that positive infinity, and that's what Bali has been kind of educating us on, is that you have much more frequent down moves in stock prices, but the significant moves are positive. The significant moves are so there's this presence going on where that's that fatter tail of positive in terms of towards infinity. So that's something that we're trying to wrap our heads around with stock prices, and it's difficult to really conceptualize at first, but then you start to look at prices and the way that things move, and like in terms of like the S&P 500, and you see these down moves, but they're in the grand scheme of things, they're really insignificant, and we're moving towards a theoretical infinity, and that's something that I'm going to try to better explain, and that will be a function of how much we learn.
Gives the space about specifically this, which is, since there's no math around the log normal, around the tail risk to the upside, since you can't, I shouldn't say.
There's not enough instances to get good tests about
we
can guess it looks like this, but maybe it doesn't. We don't have enough data.
Since you can't model it, the argument in the industry has long been that since you can't model it, you can't do it because you don't have any idea what your risk is going to look like under certain scenarios. We argue that if you stay small, you're fine. It's not going to matter.
If you only put on defined risk trades.
No. It's going to do it defined risk.
Right, but that is an easy way to get out of the heavy tails.
Forget about that. We're talking about short strangle.
Right.
Our argument is that the heavy tail there, even though you can't model it, if you stay small, you can control it. The argument has long been.
See that right there. If you stay small, you can control it. That doesn't seem to be right. I mean, because if think about if you sell a call or if you short a future, that your risk is infinite, and there's no way to be able to control that. So that's why we see shorting as an unwise move when we're dealing with log normal distributions, which is price. That it doesn't make sense to do that because there's no way that you can stay small like Tom's talking about. But let's see if there's any rationale from Jacob's end.
That you have to buy that crap because since you can't model, it can't be shorted. And that's when genius fails and everything else. We talked a little about this yesterday.
I don't know. I do an iron condor, cover it far enough out.
All right. So
don't expose yourself to unknowable things for no day.
Unknowable things. Well, the problem is if you buy that crappy wing that's 1 million miles out, you're not really doing anything except take it down your return type thing. It's not that black and white.
You're buying insurance.
So what's a log normal?
Yeah, so Jacob clearly doesn't agree with what Tom's saying, and this actually goes back to bite a lot of different traders, whether you're shorting the VIX or if you're shorting Bitcoin or whatever it may be, shorting the SPY. If you're short a call, it doesn't matter. It doesn't matter the strike. It's that your risk is truly infinite, that buying that call. Just to be able to define your risk is never really a bad move if you understand the log normal distribution, and clearly Jacob knows what he's talking about.
Well, that's not insurance. That's just you're buying the ability
risk
to make the trade.
Right.
That's all you're doing. But okay, so I'm gonna go.
Mine's down 27.
I know. So what's the log normal distribution like?
Right, so I was saying that people, I think, sort of have a good feel for the normal, like a normal distribution with a mean, which is just the center, and a variance, which is just how wide it is.
Yeah.
So we all sort of have a feel for that. But the log normal distribution isn't quite the same. And so up here are, in particular, if the mean of the normal distribution is written with a mu, the mean of the log normal distribution doesn't come out as e to the mu. It comes out as e to the mu plus sigma squared over 2.
This is exactly how Tony explained it yesterday. I mean, it was like...
I think I had one less little house that he was building there.
I'm just telling you, when you weren't here, he just did this whole thing. But the difference is, he just put it up on the chalkboard.
Yes.
Like this.
So the middle line is standard deviation, which is the one that people are most used to using, but is hard to interpret directly. But the bottom one is the median, and that's sort of the most important thing on the slide, which is the middle point of the probability distribution. It's the thing that you are half of the time more than and half of the time less than. And that one is still e to the mu t. That one is the immediate thing that you get from the normal distribution. It is preserved under the exponential, whereas the mean is moved. This is the important effect here.
Okay. So just for my own listening enjoyment,
For your own listening pleasure.
for my own listening pleasure, when does Jacob or how does Jacob feel comfortable using a short straddle/strangle?
Never.
I mean, I haven't done that, so...
Yeah.
I understand. What I'm saying is, but you.
What would it take to talk me into doing it?
No. I'm not. I'm just saying, just playfully. It doesn't.
I don't see a reason to
morally.
do it. I don't see a reason to do it.
Yeah, because since you can't model the.
I also don't see a reason to, like, you will reduce your capital requirement if you get a better return on capital.
But you would then argue that you do see a reason to sell a naked put.
No. I mean, you could sell naked puts, right? You can do downside risk because that's catch up.
You can't process this. I knew there was something. I couldn't figure out what it was. So you can't, because this is my problem with, this is one of my problems.
It's not that he can't process it. It's that it's that he can process it, and he knows the math is that naked risk in either direction is unwise, but specifically in on the call side of things, naked risk is I mean, it doesn't make any sense. Think about do you want to mess around with infinite loss?
Problems with finance, with the finance and academia.
Yeah.
Is that because it can't be modeled, it can't be processed.
I mean, no, it can be modeled. It is modeled.
That's the log normal distribution.
You
That's
have
the
a limited
model.
upside risk, and the tails are... If the tails are really, really actually very small, like Gaussian or sub-Gaussian, then you're probably okay. But there's no way to know that. And if the tails are not very narrow, and sort of empirically they seem like they're not that narrow, you probably don't want to be exposed to what's going on out there. You don't know what it is, but you know that it happens more often.
So the normal distribution is this right here, with the symmetrical tails, and the log normal distribution is the fat tail leading towards infinity and being bound by 0.
Often that our models predict, and that it's bad.
Except if you're in some kind of an index product, it would bother you less.
Just because they have, I mean, they're more they're a little bit more, but it still doesn't
Not
seem
subject to a takeover, that kind of thing. In particular, the median is always less than the mean by a factor of, I don't know.
E to the minus, so that'd be volatility squared over 2. Volatility squared over 2t.
Okay. So what does that mean, volatility squared over 2t?
Right, so that's that factor that's in a lot of the Black-Scholes equations. It's because it's this drift correction as you go between the exponential and the lower one. What it means is that the mean, which is if we're going to be arbitrage free, has to be sort of equal to the risk-free rate, which is what we're about to get to. The mean has to be equal to the risk-free rate, and if we're arbitrage free, the median is always going to be less than that. So that 50% line is you're going to be below the mean more than half the time, and above the mean less than half the time. But the mean isn't 1 or 0, right? It isn't the natural center because it has the risk-free rate in it.
What is the drift? And how is it different from the risk-free rate?
Right, and the answer is that in order to balance this arbitrage assumption, the drift has to be the risk-free rate minus sigma squared over 2.
Okay, so the drift is... So what does that mean in English?
What it means is that because once you've gone through the exponential, you can't go below 0, but you can go all the way out to infinity. When you start taking averages, like you need to make sure that you're arbitrage free, those ones play in more because they're really big, and the fact that we replace what used to be minus 100 with 0 isn't nearly as important as the fact that we replace what used to be 100 with e to the 100, right? E to the 100 is an enormous number, and so you get this ballooning in the expected value. So in order to have this not be an arbitrage, it actually has to have a drift downward based on its volatility.
So I'm reading this here. If there is no arbitrage, then buying the asset now must be, on average, equivalent to investing at the risk-free rate. What is the current risk-free rate?
I have no idea.
Okay.
All right, let's replay that real quick.
Less than half the time. But the mean isn't 0.
Just about that drift factor.
Right? It isn't the natural center because it has the risk-free rate in it.
What is the drift? And how is it different from the risk-free rate?
Right, and the answer is that in order to balance this arbitrage assumption, the drift has to be the risk-free rate minus sigma squared over 2.
Sigma squared
Okay,
over 2.
So the drift is... So what does that mean in English?
What it means is that because once you've gone through the exponential, you can't go below 0, but you can go all the way out to infinity. When you start taking averages, like you need to make sure that you're arbitrage free, those ones play in more because they're really big, and the fact that we replace what used to be minus 100 with 0 isn't nearly as important as the fact that we replace what used to be 100 with e to the 100, right? E to the 100 is an enormous number, and so you get this ballooning in the expected value. So in order to have this not be an arbitrage,
So that's where the normal distribution is faulted. Is in terms of stock prices is that it's kind of being infinite is something that isn't really represented in the normal distribution. So that's why the log normal distribution the negative 100 has turned to 0 because stock prices can't go below 0, obviously, and that it's not just 100, which is like this bound that the normal distribution has. The log normal distribution is taking that 100 and turning it into an exponential, which is allowing it to really go out to infinity. So these people that are confused by the S&P being towards 5,000 and the Nasdaq being at towards 16,000, they're confused by it because and they look at these charts and they look like it's a straight line up or something resembling that, and that's the infinite nature that we have trouble wrapping our minds around, that these prices are truly infinite, and we can't really comprehend that. So that's why we're gonna keep pushing home these points. I mean, we're not gonna learn all this stuff in one day. It just doesn't work like that. But this is like the fundamental basis for a lot of different things. So especially for the way that we're looking at stock prices, and that's really how we're making decisions and things like that. So we'll keep going.
arbitrage, it actually has to have a drift downward based on its volatility.
drift
So I'm
downward.
reading this here. If there is no arbitrage, then buying the asset now must be, on average, equivalent to investing at the risk-free rate. What is the current risk-free rate?
I have no idea.
Okay. It's about what?
Two
I don't know.
Yeah,
Maybe something like that.
2%.
Okay. So if there's no arbitrage, then buying an asset now must, on average, be equivalent.
And the risk-free rate would be like a yield on a government bond. That's what they consider the risk-free rate. In my opinion, it would, I mean, not my opinion, but a way that you could also say the S&P 500. But that's not truly risk-free, and neither are bonds.
To investing at a 2% rate, which would seem really low. But this means under Black-Scholes assumptions that given for T is time,
Yeah.
that given for time, sigma,
No, that's an S.
that's just an S? I know, I get this, it will be log normally distributed. Well,
That's the current price. ST is the current price.
Oh, ST is the current price. Okay,
Hey,
time,
monkey, current price.
current price will be log normally distributed, and then you can throw this together.
Right. So this is just putting in the. Once we know what mu is, it is mu is r minus sigma squared over 2, and sort of the important one is below that half of the time you'll be below that value, e to the r minus sigma squared over 2t, and half of the time it'll be above that value. And this is the prediction of Black-Scholes. And so you can distinguish when there's more up days or down days by comparing r to sigma squared over 2.
Easier said than done.
You need to know risk rate, and you want to take an implied volatility.
Yeah.
Then it's like an SAT question.
Yes. Well, that's way harder than an SAT question. It's 9:08 on
Part of the
Thursday.
stuff that was on the Series 7, I think I read.
It's Thursday, April 2nd, and if you're not confused yet, we're going to get you there. We're working. He's Jacob, and this is our segment called the Skinny on Option Map.
All right, cool. Excuse me. So, we'll kind of do stuff like that, and as definitely as I up my streaming game. What's going on over here? Yeah, so there's some skip frames going on or whatever, but yeah. So as I up my streaming abilities, we'll be able to learn from Tastytrade, from Taleb, hopefully from Bali, and just kind of learn and so we can put these things into practice. So I mean, a great way to get started here is just to yeah. So let's put some of that into practice, about how stock prices can go to infinity and they're bound by zero, and they have a much fatter tail that's towards infinity. So yeah, let's keep going on here with what we're seeing on TV. So TV, otherwise known as TradingView. All right, so we'll make sure that we're on the log setting, and see the difference right there. Log is something that takes into account compounding and that function. But yeah, we can go over that as well. But yeah, what we just did is essentially that with the way that stock prices are. But so let's kind of look at some things here, I guess, and kind of yeah. I just want to be able to build up a base with our viewers and see where we're all at, and because there'll be viewers that probably have a higher knowledge than I do. So let's kind of put our heads together. So let me just double check over here. I just want to make sure that you guys are on the same. Hey, thanks a lot, Weebos. You're the fucking man. So, all right. so yeah, let's go over another concept. So yeah, so thinking about that, how these stock prices move. I mean, I can visually show that with a BApig tool. We can go with the probability cone, you know, and this kind of represents that in a sense. And we can look at a monthly, right, or we can even look at a quarterly, right. I mean, if this doesn't characterize a log normal distribution, then I mean, or if a log normal distribution doesn't characterize this, then I'd be happy to know what does, because you can kind of see that over time. But all right, so what we'll do here is, so this is the BApig Cone Pro. It's insane, the level of quantitative analysis that our team is hooking us up with. So thank you very much. I'm incredibly lucky to be able to even use this thing. All right, so what we'll do is we'll look at quarterlies, and so looking back for the past 16 quarters, that's going to be our sample size. Or we can go further back. We'll go back to the inception, 91 quarters. Okay, so we'll go back 91. We'll keep the drift on. So we'll go back 91, drift on, and these will give us probabilities here. And let's make sure that we're symmetrical. Okay, we are. And let's do the up probability here. Yeah, keep it in the YouTube, just so that I can keep track of the stream. Sorry about being so bad about this, guys. Like, I'm not a streamer, but all right. So, but I'll get there. All right. So yeah. So we can see here that I mean, there's a 0.15% chance that we're at 160, right, towards zero, and there's a 0.15% chance that we're at 25,000 by 2034, and there's a 5% chance. So you can see how there is the probabilities. There is a lot of. This is more of an advanced concept here, but like looking at those probabilities of a gain of possibly 250% and a loss of 80%. Over the course of about 10 years, that's something that is of note, to kind of like looking at that. I mean, which way would you want to bet? 80% return on your short, or 250% return on your long? I mean, it's something that is to take into account, but maybe I'm misinterpreting that. But let me start kind of talking about some things that are more in my wheelhouse. This is stuff that I learn about and just kind of try to up my knowledge on. I don't really use the tools like that. But yeah, so yeah, that's part of the learning type of thing. But yeah, so we can go over here. I don't want to overcomplicate things for newer people, but at the same time, I know that there are some more advanced people that are looking to gain some insight. So for the next hour or so, we'll kind of just talk about the tools and the way that I use them, because I think that's a little bit more candid, and I have much better ability to be able to kind of talk about. But remember that about how stock prices are log normally distributed. Another aspect is volatility. That's another thing that helps to describe returns. Is volatility. So what we can do here. This is what really got me acquainted with Bali and the math, and this is an indicator that is I mean, fundamental in it should be fundamental in finance, which I mean for at least in my experience it is. So this indicator displays historical volatility percentile. Historical volatility percentile tells the percentage of days over the past year that were below the current historical volatility. That's huge because historical volatility is unbounded. So you could, it's bounded at 0 and it goes to infinity with historical volatility, and the percentile makes it bounded to 100. So then you can put that in. Okay, so if I put in my sample size for the past 250 days, then over the past 250 days, if there's a 5%, then 5% of days were less volatile than today. So then I should be looking at more of a volatility expansion, and that goes into characteristics of volatility. And Jacob has a great skinny, and it's on stochastic differential equations, and that's kind of so if we're thinking about stock prices and how they have that infinite nature, then there's no real point in looking at that price, because the price is really irrelevant if it can go to infinity. There's no bounding of it, and so what do you care about the price? I mean, it doesn't seem like there's much value of price. So then once we start taking derivatives of price, then there's start to be there's some different characteristics where you can assign that normal distribution in a sense, and you can have these different types of characteristics that give you much more insight, as opposed to the S&P's trading at 5,000 today. Oh, it's at all-time highs. That's the biggest meme that I hear on financial networks, is that they love pointing out the fact that stock prices are at all-time highs. I mean, they can go to infinity. So what does it matter that it's at an all-time high? I mean, that right there is something that I think that is. I think it's purposely misleading. That, I mean, over time they're going to be making all-time highs, and it doesn't tell you anything. So that's why with BApig there's a much more detailed understanding of the characteristics of these distributions, and that's the point that I'm trying to or kind of show and practice. So yeah, we're looking at the historical volatility percentile. So now this is a derivative of price and returns, and it's showing you the variance of returns, essentially, and keeping it going. So for instance, if HVP is 90%, the understanding is that historical volatility traded below the current level for 90% of the past year's data. So that would be when you see those really high red bars right there. That's and volatility really, yeah, it isn't bounded, but this indicator right here allows you to see those extremes much better, and relative to over the past year of data, 2 years of data, 10 years of data, however much data that you have, which is why we like assets that have higher amounts of data, so that we can keep on so that we can build up some of these types of so that we can kind of observe these things within these random walks, which is price, right? So let's keep going. On the other hand, if HVP is 10%, the understanding is that historical volatility has only traded below the current levels 10% of the time over the past year. So that volatility is relatively inexpensive. So all right, so now let's throw this indicator up with a primary understanding of what's going on. So let's throw it up here, or let's display it on the chart. Seems like I already have it on there. So what we'll do is we'll look back for the past, 15 works. And then, or we could actually do the past 5 quarters. So remember that this is a quarterly chart, so the candle closures will be based on 90 days or with the price action around there. And then for the annual, we'll do 90. Okay, so there's not enough data there. So maybe we'll do 550. All right, cool. So then this is a quarterly volatility right here. So volatility was low relative to the data that we had for quarterly data right there, and so then we had an expansion right there, and then volatility is low again. And notice how we have these right here in October 2018, another expansion right there. So just kind of using these indicators. This is much more like this indicator right here is much more important than what the price of the Nasdaq is. Like that's exactly like it's the reason why the reason why that Bali bounded volatility from 0 to 100. Well, obviously 0, but anyway is basically to be able to put it into context with other it's a way to kind of look for contractions and expansions, but to put it into context, it's a statistical kind of just lens that we're looking at things. But so continuing on here, and then we moved on with some innovations into the historical volatility estimator. And this goes much deeper into like historical volatility is a statistical measure of the dispersion of returns for a given security or index over a given period. This indicator provides different historical volatility model estimators with percentile gradient coloring and volatility stats panel. So think about that. Like is a statistical measure of the dispersion of returns for a given security. That right there is and you can see how historical volatility itself being unbounded, you can see historical volatility of 250, and then even in real volatile times, you can see how comparing to the coronavirus dump, every single thing is going to seem kind of not as significant. Continuing on. So these are some of the fundamentals and just kind of what I do to kind of prime myself and just kind of be able to look at things much better. Be able to just kind of get my head in for learning what this like actually is, not just having it up on your chart. It's much different. Like you can hear me stumble over and create word salads and all that bullshit and like it seems like you're LARPing or whatever, and that's what I'm trying to get rid of is being able to succinctly describe these things and be able to put it into context as well, because anybody can just put it up on their chart and seem like they're next level or whatever, but realistically it's the coders who are next level and just we're just trying to keep up and learn all of this. So that's volatility in a terrible way to describe it, but it's a way to kind of look at so price in our sense in the way that we look at price is really irrelevant, and we want to look at returns, and we want to because returns are much closer to a normal distribution, because you can have negative returns and positive returns, but looking at that, so we can kind of go in and the evidence of a random walk. We can go in and we can. There's another BApig tool for that as well, and that's the variance ratio test. So this describes the presence of a random walk by looking at the variances. So we can look at that as well. So whenever you're using these tools, I mean, yeah, I can have 10 different tools up, but I can lack a fundamental understanding of what any of these tools mean, and a lot of that then it really is LARPing, like live action role playing, like it's bullshit, you know, and you think you can understand it in your head and be like, oh yeah, I understand that the difference between these lines. It describes whether how much that returns are following a random walk, right? But being able to describe that to somebody is much different, and that's the point that I hope to get to, is be able to describe that coherently. So yeah, so this test right here is testing returns for the presence of a random walk, but I do a poor job of being able to explain that, but let's get it over here. But all of these have descriptions, so the descriptions is really what you should go off of, not idiots like me. But anyway, so we go in finance. People usually assume that price follows a random walk, or more precisely, a geometric Brownian motion. 1988, Lowe and McKinley came up with a variance ratio test to refute the random walk hypothesis and efficient market hypothesis. Efficient market hypothesis is basically saying that stock prices are correct. And we just went over the random walk about how going into different spaces, you have that +1, -1, +1, -1, and there are points in the throughout that are observed where there is actual points where prices are not following a random walk, and those are of note, and those are opportunities to express certain types of they're just opportunities. So that's like, I mean, if I told you that the stock market was just random and that all the odds are the same of getting positive returns or negative returns, then why the hell would you even fire up TradingView and look at returns? You know, that's the big part is that, I mean, so where's the edge in looking at this stuff, and the edge is that when you're monitoring these things is that there are periods where the random walk is actually not happening. And those are of note, and where there are periods where volatility is incredibly high, and there are periods where volatility is incredibly low, and those are opportunities because there are certain properties of that metric. So then you once you get this fundamental understanding of the properties, then you can put those into practice when you get these occurrences. And so keep on going with learning these types of descriptions and stuff like that. So these guys they came up with the variance ratio test to refute the random walk hypothesis and efficient market hypothesis. So the variance ratio test is a simple test for market efficiency, autocorrelation, and whether price follows a random walk. In random walks, variables should be independently and identically distributed. Therefore, the variance should be constantly scaled throughout the samples. So think about that. Therefore, so if there was if they were always following a random walk, then the variance should be pretty much identical, right? And the distribution of the variance should be evenly distributed from what we're learning from the description, and so therefore the variance should be constantly scaled throughout the samples. For example, variance sampled in 4 bar should be close to 4 times the variance sampled in 1 bar, which makes sense. Like that right there. So So if you take a sample of 4 bars, the variance should be 4 times than the variance of 1 bar, but it's not. There's times where you get like during the coronavirus, there's the variance in that one single candle is more than the prior 10, right? I don't know if that's specifically true, but you can kind of observe that with these things. So if these were actually following a random walk, then you wouldn't have those instances where the variance is incredibly skewed for one candle or for multiple candles, or you get 10 candles where the variance is incredibly high, and then so that's kind of what we're looking at here with this test. And so first we calculate 1 period sample. Oh yeah, let's go over that one more time. So for example, variance sampled in 4 bar should be close to 4 times the variance sampled in 1 bar. The variance ratio test tests if the variances are scaled constantly. First, we calculate 1 period sampled variance as the basis variance of the test. So 1 period. So as I take that, it'd be 1 bar, right? 1 candle, one quarter, right? Or whatever time frame you're on, right? And then we compute the variance sampled by 2 bar, 4 bar, 8 bar, 16 bar, 32 bar. We use power of 2 as a sample period here, but any multiple periods work as the variance scaling applies. So that's exactly what Jacob was saying on Tastytrade about how the spaces and how you have the +1, -1, +1, -1 in a random walk, but that's not really the case with stock returns. After we calculated all the sample variance, we scale the higher sampled period variance in terms of basis variance. After we calculated all the sample variance, we scaled the higher sampled period variance in terms of basis variance, 1 period sampled variance. We can't actually divide K from the K period sampled variance directly here to scale the variance because it's biased. The following chart shows unbiased scaling variances. After we finish scaling, the higher period and lower period variance should have pretty close values if it's following a random walk. The closer price is to random walk, the smaller difference they will have. That's a major takeaway. Is that so? The closer price is to a random walk, the smaller difference they will have. So we're looking at this right here. So these shouldn't have that large of a difference if they're following a random walk. So let's continue. So that's a major key with this indicator is looking at the differences of the different ratio tests. So the variance ratio is just the higher period sampled scaled variance divided by lower period sampled variance. Because their values are close, the ratio should be around 1. And the variance ratio test will test how different the ratio is from 1. Low and McKinley suggests variance ratio -1 follow the standard normal distribution with mean 0 and standard deviation. We can get standard deviation from sample size t and period k. Standard deviation squared equals 2 times 2k minus 1 times k minus 1 divided by 3k times t. The formula we use here doesn't take into account heteroscedasticity, and heteroscedasticity is that returns are they don't move in the same manner. So you're not going to have like homoscedasticity is that you're going to have plus you're gonna have returns move in the same type of variance, but returns are actually heteroscedastic, and that is the characteristic of returns where you have high amounts of variance in between returns. And it's not all the time. Like these, we're just using these statistical lenses to put over stock returns, and that's just what we're observing. So when there's a market that's very heteroscedastic, then you're going to have then there's going to be a lot of variance in between returns. So you're going to have some days where Nasdaq is only up 50 points, and then you're going to have other days where, like yesterday, Nasdaq's up 400 points. There's not a lot of similarity in between those, and that is something of note, and like the way to look at things. So that's something that we can dive deeper into as well. Once we know the standard deviation, we can get the z-score from dividing standard deviation from the variance ratio minus 1. We can apply the standard normal test scores or the z-scores. The user can choose the critical value based on the significance. Default is 5% and critical value 1.96. This means the z-score is above 1.96 or below 1.96. The variance ratio is significantly different from 1, and we can reject the random walk hypothesis. So that 1.96 critical value, so the critical value is right here, this yellow line right here. And this is our confidence. So this is our 95% confidence interval, and anytime that we're starting to see variance ratios outside of that, outside of our confidence interval, then there's something different going on than a random walk. So let's keep going. So you're not only looking at the differences in between the variance ratio tests on a per bar basis, but you're also looking at the difference in terms of away from its confidence interval. So let's just go over that one more time. Is we can apply the standard normal test statistics on the z-scores. The user can choose the critical value based on the significance. Default is 5% and critical value 1.96. This means when the z-score is above 1.96 or below negative 1.96, the variance ratio is significantly different from 1. If we're following a random walk all the time, then it would be 1. That's from my understanding. Let's make sure. The ratio should be around 1. But yeah, when you see these variance ratios outside of the critical values, then there's something different going on. So the variance ratio is significantly different from 1. We can reject the random walk hypothesis. And if the z-score is between 1.96 and negative 1.96, we are 95% confident that price follows a random walk. So looking at that. As we have different scale periods, some periods might have a significant z-score, some might not. Generally, if one of the z-scores is significant, we reject the random walk hypothesis. As we have different scale periods, some periods might have a significant z-score, some might not. Generally, if one of the z-scores is significant, we reject the random walk hypothesis, i.e. right now on the quarterly for the Nasdaq. Variance ratio, what you want to do is you want to turn on your labels. VRT 1. Outside of the critical value. So rejecting the random walk on a quarterly. I mean that might have something of note right there. As we learn more about how to put this into practice. As we have different scaled periods, some periods might have a significant z-score, some might not, i.e. right now. Generally, if one of the z-scores is significant, we reject the random walk hypothesis. When all the period is displayed, you can see a different behavior of short-term and long-term variance. So long-term variance is following a random walk. Short-term variance is not following a random walk, which is very, very interesting. And I think that, holy shit, that's pretty eye-opening. Shorter period, like 2-period sample, is likely to trend longer. Longer period is likely to show mean reversion. This is very clear when it's applied to a long look-back period. We also recommend users to use look-back period longer than 2 times K. Example, 4-period VRT requires 4-period VRT requires 8 bars of look-back. When it's applied to 1,000 look-back, price, log returns, show mean reversion behavior in the long run. So this massive dump right here, the massive dump in I think that was coronavirus. You see how instead of these VRT values going up, the VRT value is going down into a state of mean reversion, and not following a random walk, which makes sense because that dump seemed to be non-random. When show multiple variance ratios ticked off, the indicator shows only one line of variance ratio, and the sampling period can be adjusted in period multiplier. Flash in the background suggests when price doesn't follow a random walk. So what we can do is over here is instead of having some interpretation, we can just turn the variance ratio into a single metric. So we can go tick show multiple variance ratio stats. And right here, we can see that we're in a state of mean reversion, and that we're below the critical value, and which is why it's saying that with this flash going on, it's telling us that price is not following a random, or returns are not following a random walk, which would be interesting for. That right there is something that we need to dive more into. Is that on the quarterly for the Nasdaq that price isn't following a random walk. So then, like, if you've been following the market recently, then we can look at the daily. We can look at the daily, and I'd be willing to bet that it doesn't follow a random walk, but we'll see. So we're heading into a period of mean reversion, and it's saying that price is heading so that returns are still following a random walk on the daily, but maybe if we look at a 4-hour, over here, price not following a random walk, heading into trend. All right, but anyway, let's just stay with the quarterly analysis right here. So it's what the variance ratio test is telling us for the Nasdaq right now is that there is mean reversion going on, and that price is not following a random walk. So that's what I did, is show multiple variance ratios. I made sure to uncheck that box, and then that gave us a single variance ratio, and the flash is when the variance ratio is above or below that critical value. In order to test how useful is the variance ratio test, I used the VRT on the random walk data I simulated based on geometric Brownian motion. So so the BApig team, they simulated a geometric Brownian motion, and then via a Monte Carlo simulation, and then they analyzed that simulation with the VRT, and the VRT showed that it was a random walk at all points, which is pretty eye-opening, because clearly the VRT didn't know that there was any difference between this and an actual Bitcoin. There was so it was just basically confirming the fact that this was random, that at all points, and going through points of trend and mean reversion. So in order to test how useful is the variance ratio test, I used the VRT on random walk data I simulated based on geometric Brownian motion. The data I simulated has 0.001 drift and constant volatility. It's not a true random walk because I use a pseudo-random number generator in the script. Not true random numbers, but it's pretty damn close. The result shows VRT is between the critical value most of the time, which suggests it follows a random walk. So when those critical values, when they're very close together, so if this were even more random, if this were a true random generator, which those take up a lot of resources or whatever. If this were truly random, then you'd see those VRT values look like one line as opposed to 5 separate lines. So when it looks like really 5 separate lines, then you can really see that returns are not following random walk. And then for people that are too lazy to read math, here is how to use this indicator. But I mean, if you didn't read all that, then your understanding is going to be much less than somebody who has, unless you're quantitatively minded or something like that. Red means possible negative autocorrelation, mean reversion. Blue means positive autocorrelation, trend. So negative autocorrelation or mean reversion is simply saying that the values or the returns are going to be are going to be more homoscedastic, I think, in a sense, and they're not going to be as large when there's mean reversions going on. So that there's going to be, or that there is. Sorry about that. That there is that the returns are less so. When there's a mean reversion going on, it's that the returns are they're not as large, essentially. That the mean reversion is not so that the returns they're not as large, and then when things are trending, then you're going to see large returns in either direction. It's not directional, but it's just telling you about the characteristic of those returns. 2-period variance ratio is the first order autocorrelation. We suggest users open indicator name labels and values on the side so they can see which period variance ratio is significant. Above or below critical values mean price does not follow a random walk. Between critical levels means price follows a random walk. Main purpose of this test. So going back to that trend and mean reversion. So when things are trending, you're going to see high amounts of variance, and then when things are mean reverting, you're going to see lower amounts of variance. Just from the way that just from the way that I interpret that. But I mean, there's another indicator for that as well, and that's the Hurst exponent. And there's another iteration of this, and that's the D-trend fluctuation analysis. We can go into that as well. But the Hurst exponent is used to measure a long-term memory of time series. It relates to the autocorrelations of the time series and the rate at which these decrease as the lag between pairs of values increase. The Hurst exponent is referred to as the index of dependence or index of long-range dependence. So kind of using these tools together, when price isn't following a random walk and price is trending, then it seems like there'd be some room for opportunity, and then as well as when price is following a random walk, when returns are following a random walk, and returns are just they're just a derivative of price, right? Maybe I'm mistaken with that, but it is. But anyway, so like that's kind of like the thinking behind these indicators is that like price returns aren't always following a random walk, so then there's opportunity to kind of use these ways of these perspectives of looking or these mathematical functions to be able to use different types of methods of trading. Like one thing that I was thinking about is that as an options trader this would be useful. Nobody's just an options trader. That doesn't make sense. Like, I know Tastytrade tries to be just options because of quote unquote capital efficiency, but nobody's like, if you're a real trader and not a LARPer, then I'm not calling out. I mean, you can not be a LARPer and you can only trade options, but that doesn't seem wise during the different states of the market. When things are trending and things aren't following a random walk, then why in the hell would you be selling premium? You know, like you're gonna get high amounts of volatility, and you're going to be and it's going to be non-random. So you're going to be short. So you're going to be selling options during that time that have infinite amounts of gains. That doesn't seem to make sense at all. And so as a trader, you're using these different tools, which are products, like different or not products but derivatives. So you're using these different tools to state your bias in a variety of different ways. I mean, so you can so don't look at it as, oh, I'm an options trader, or oh, I'm a futures trader, or oh, I'm a stock trader. That doesn't make sense. The reason why we have all those derivatives is to hedge, is to state different biases, and that's where these things come into play. And so if you limit yourself to one derivative, or if you just limit yourself to stock, then you're rarely going to be able to express what these indicators are telling you. So going back to the VRT, and when the lines turn blue above a certain value, and that's telling you that returns are trending, and when the line turns red, when the lines are red, or the variance ratios are red, like, don't just look at them as lines. Like, that's a big thing, is that don't just say, oh yeah, like this is going up in a trend. Each of those are a test of variance. So that's like a big thing is that I found myself doing, is just having like a bunch of different indicators up, but not really having a fundamental understanding of what one of them has. So that's what I'm trying to kind of eliminate is a lot of that bullshit, where people don't actually understand what's going on with returns, and it's something that can definitely hurt. For instance, I'll go over to 2-year yields, and I thought it would be smart to short that because it was outside of probability cone, right? I thought I was being smart, you know. I thought I was like, oh, you know, let's short some 2-year yields. And I was lucky that it didn't come back to fucking bite me, but yeah. So this is like kind of my thinking, and that's why it's great to kind of put yourself on blast in a sense, and put yourself out there and say, hey, this is the way that I'm looking at it, at these indicators, and or this is the way that I'm looking at price, or right now it's yield, right? That oh, it's outside of this cone or whatever, that I should short it because there's going to be some type of reversion back to a mean, and that couldn't be further from the truth. Like, that's going to get you fucking wrecked, man. Sorry to put some technical analysis terms out there and stuff like that. I'm eliminating that from my vocabulary, but yeah, I saw the 2-year yield, and I said, oh, let me short this, you know, let me short this because on a bi-weekly it's outside of the 1% cone, right? It's not there right now, but anyway, it's outside of the 0.15% cone, right? But just because there's a low probability of something happening, that doesn't paint the entire picture. So yeah, you can have the cone, right? The cone is great. It's fucking awesome. But and there's a 0.15% chance that this quarterly candle closes in the next 23 days above that 0.6 value, 0.53 value. So the good thing about yields is that there's a shit ton of data. So we can go over and we can go back 132 bars. So that would take into the life of yields, right? And so that kind of pushed out our probabilities a little bit, right? And then, we could turn drift on as well if we want. And and yeah, so this really is a fat-tailed event in terms of our probability cone, showing us that yields are outside of that, but that's not painting the entire picture of returns, and that's kind of the level of insight that you get and the level of collaboration that you get with the BApig team is that you go into the incubator and you start talking, and very quickly people will be there to tell you that you're not looking at things correctly, or you're not putting on that type of statistical pair of glasses that are okay. Like, we have all these tools, but if you have a chart that looks like this, well, you better know what all this means, and better be able to interpret it, and with a like down to a granular level of detail, and once you can, it really does change your perspective on what the Nasdaq 100 or whatever is trading at 16,285. I mean, what that really means, you know, and you don't give a shit about 16,285, you know, or 16,300, you know, like you're looking more at returns, and that's like the real draw to the BApig team, and the incubator is learning about those things, and it just shows that I mean, Bali knows all this stuff. You know, a lot of these guys know all this stuff, and they go into these rooms, and they spend time explaining it, and kind of and that's telling right there. You know, like being in a lot of different other servers, there's this tribal knowledge. And it's so difficult to learn. I mean, it's like, oh, a lot of it comes down to my experience, and it's like, well, something that's going to infinity. Your experience has little to provide there. So silly me, like saying, oh, you know, Tastytrade's got this 2-year bond, 2-year yield product. And I'm thinking about going short, and it's something that they kind of they kind of put out there is like, oh yeah, you know, you have high amounts of capital efficiency and things like that, and you know, like, oh, let's go short here, because it's outside of the cone, and it's like, oh, well, that's my criteria for whether I'm long or short, but there's so much more that goes into it, and that's why that there's all this other stuff, you know, and I mean, Bali, that's what they use, you know, which is incredible, really. And so I'm like, oh, I'm thinking, you know, I'm smart, you know, I'm outside the probability cone. How many tasty traders have a probability cone? It's outside of the 0.15%. I'm thinking it's gonna go back to 0.29. That's gonna make me like insane amounts of gains on the short. And you look at this right here, and not only are we getting towards a spot of a non-random walk, but returns are trending, and returns being trending means that there's going to be high amounts of volatility. So then we could go down here, and we could put our critical value at 10%, and it'd probably say that things are not in a random walk. Yeah. So if we put our critical value down a little bit more, and say, oh, we want to have a 90% confidence that returns are following a random walk, then things are not following a random walk as of July, but then we're starting to see that kind of go back into a random walk. So looking at things like that, and I mean, the probability cone, that's something that requires a monthly subscription to BApig, but I mean, the incubator and the variance ratio test and the HVP, those are provided for free. I mean, no reason why they should be free, but this is the type of stuff that is, I mean, they're literally given to you for free, something that I mean, right here, like, all right, so I mean, looking at things right here, like just because it's a free indicator doesn't mean that it's useless. Like it's I mean, the use in these indicators are incredible. So we see a state of mean reversion right there, right here, yeah, and so right here you see that volatility was low, and that there was an 80% reduction in the 2-year yield, and that volatility continued to stay high. Then volatility started to drop, and volatility picked back up. But I mean, looking at it with the VRT as well, that this was signaling that yields are going to be a good product to trade, or a good product to possibly long, or because you're going to see high amounts of volatility, even with the HVP metric kind of saying that things were going to cool off. So it really does take a lot of different metrics to kind of and lenses to be able to kind of wrap your head around what a 2-year yield of 0.71 or 71 basis points really means. So that's kind of a way to get yourself like what type of bias would you want when volatility is high and things are not following a random walk and there's trend. What would you want to do right there? I can tell you one thing: I wouldn't want to be making markets selling options. I can tell you another thing: after an 80% or 90% decline, I wouldn't want to be short 2-year yields. You wouldn't really want to be short really ever, but here, seeing that with the characteristic right there, I mean, that would be like saying, oh, maybe I'd want to long a future after a 90% decline, and the variance ratio test is signaling that there's trend right there, and if we put this moving average right here, we can put this to there's about 90 bars worth of data right there, I think, or maybe even more, right? Let's go back. 130. So if we put the moving average at 100, it should be somewhere near 50. Won't show that, but anyway. If we put the variance, so if we put this at towards like 500, right, for the past 500 weeks, you can see how the average is more or less 50, and that kind of just show, well, that's just the function of the percentile being bounded to 0 or 100, but also the fact that the average volatility, there is a characteristic of volatility where a lot of people, they quote it, they say mean reversion in volatility, saying so when volatility is high, it will revert back to its average, and when volatility is low, it will revert back to its average, which I definitely that's like volatility being a property of returns, and just being able to kind of see the advantage of looking at volatility as opposed to volatility and returns and things like that, and this whole lens. That's what I'm really trying to express, is that there is that looking at returns and looking at these different statistical contexts is far more better than saying that there's some type of wedge, or I don't even know what the hell, or head and shoulders or whatever, or that price is too high or all-time highs, just is not the right way. Yeah, and I'm not trying to shell or anything like that. I'm just trying to say that this is, I mean, this kind of I just feel lucky to be here, and just kind of just kind of want to show I mean the different ways of using the tools, but yeah, do you think that you may not have given it enough time for the distribution to play out? It is a quarterly, and yeah, totally, no doubt about that. That was more of, but just kind of looking at the macro context. But yeah, you're so right. Is that did you give it enough time to play out? And it looks like it is, that there is some type of that we're going back into a random walk. The trend is starting to move down. The trend is starting to move down, but yeah, giving it time to play out is definitely something. But that's the way that you express your position as well. So if you're short futures, it's going to be much different than short a call spread a year out. So that's something that is totally right. Did you give your position enough time to play out? So these are some fundamental types of things that I want to show. So what we'll do is we'll keep up this chart, and we'll add things that we find. And what we can also do is we can put our Hurst exponent up as well, but we can put up our Hurst exponent, and then we can see that things are trending. But yeah, a lot of trading is how are you going to express your bias? How are you going to express that statistical bias? How are you going to play that? Because if you don't play it in a proper way, then you may not, you may have the proper bias, but you may not have the ability to stay in that position. I didn't play it on a quarterly, but I was looking at a variety of different things, and that just shows like the flaws in my logic. And I'm far from perfect, and I'm not trying to act like anything like that. Like I started learning from a guru, and that's something that really messed up kind of my whole. A lot of that of learning and even learning from Tastytrade, they're not learning this or they're not practicing the same way. They preach a lot of it, but they don't actually they don't like Tom and like some of these traders, like they say they understand the math, but then they act differently. So that shows that they don't actually understand the math. So all right, let's see what's going on in the markets. We definitely made some progress today. I'll definitely do some edits and stuff like that, and be able to put it out a lot more coherently as I gather some get this fucking word salad out of my brain, and a lot of this LARPing bullshit, because I'm gonna tell you right now that it's very appealing to be a fucking LARPer, but then when you actually have real money on the line, it's much different. But then when positions go your way, that you can either feel like you're really smart or really dumb with trading, but that's just a function of the randomness, unless you have a really good understanding of what's going on, and that's what these tools help us do. I mean, I'm not here to bullshit. I'm not here to make money off of the stream or anything like that, or pump subscriptions or anything like that. It's just that I've been doing this for some time, and I see the flaws in what I do, and I want to make sure that new people aren't falling down that same flawed logic, but I also want people to know that they've found a great place to get out of that bullshit retail trap that a lot of us are in. and yeah, so all right, yeah, so we can look at some things and kind of put that into context. I know now you're gonna ask, what are these dots? And that's the expected move, and that's similar to the probability cone, except for the fact that it's not projected, obviously, it's not projected further into the future. It is telling you a monthly probability here. I like to look at monthly probabilities, look at higher time frame probabilities, because there's looking at those, there's I mean, obviously there's a lot of opportunity there, and the reason why I like looking at a higher time frame probability, higher time frame probability or expected move, is because the higher returns are over longer periods of time, obviously. So looking at those probabilities are much more than just and they stay a little bit more consistent on a month-to-month basis as opposed to a day-to-day basis. But so I just have a market drivers list. I'll post this in the incubator, and you guys can say this isn't a market driver, or this is, and or whatever, and you guys can add to the list or whatever. So it seems like the 3-month Treasury bill, it's pumping up 20%. I don't really have a lot of familiarity with that, but I mean, something that we want to look at as far as let's start off with Bitcoin. A lot of us like Bitcoin, or a lot of us have Bitcoin, right? So let's start off with Bitcoin. Maybe we'll start off with the dollar. We'll do Bitcoin first, and then we'll move on to the dollar and stuff like that. But yeah, so just the way that I'm looking at things here. So what we have here is Bitcoin on the 3-day. I'll change that over to a 7-day, and the expected move. The expected move is on a 1 month, and it's at 16. I prefer it to be at 24 for the past 2 years worth of data. That's our sample size, and then 12% for the white box right here. So one tail, the right tail, and the left tail. So then if I wanted to make this like a higher probability, if I want to make it like closer to a first standard deviation, something we're more familiar with, then I could put that at 32, and then I could put the downside probability at 32 as well. And then you could see, okay, that there's a 32% chance of Bitcoin closing at 64,000 when that probability was. Make sure that we turn real time on, right? And that Bitcoin's outside of that first standard deviation on the monthly. So we'll keep it like that, just to kind of conceptualize the fact that the first standard deviation is this white box, and then there's the second standard deviation, and then so all these probabilities you want to divide by 2 for each line. So because there's obviously 2 tails to the to the probabilities, I guess, and so the probability being at 2.5% chance to get down to 30,000, and 2.5% chance of not just getting down but closing, that Bitcoin's closing price would be at 80,000, and then 3 sigma, which would be 0.3% chance or 0.15% chance per tail. 0.15% chance. So there's a 0.15% chance that Bitcoin closes at 93,000, and there's a 0.15% chance that Bitcoin closes at 13,000 at Sments. And kind of keeping on here. So yeah, so we look at this right here, and then that green line right there is the center of the distribution. I want to kind of look more into that center line. Maybe we can look at the actual, and I think that if you put these, if you favorite these, you can still look at the description. So if you're thinking about getting the indicators or whatever, or if you're waiting for that, then you can still learn more about that, right? So this expected move, and so it's assigning probabilities to basically returns, right? And so we're looking at this, and so probabilities for Bitcoin price closing at certain levels or SPY closing at different levels and stuff like that. Upgrade version of expected move, use better fit distribution, maximum likelihood estimation for Laplace distribution parameters, gives probability range more accurate than the normal expected move, which uses normal distribution assumption for returns. It can take into account fatter tails, volatility clustering during low volatility, so it will be thinner in the body. And so think about that. Maximum likelihood estimation for Laplace distribution parameters, so gives probability range more accurate than the normal expected move, which uses normal distribution assumption for returns. So this is using a different distribution assumption. I think that maybe there'd be a distributional assumption for returns. It takes into account fatter tails and volatility clustering during low volatility, so it will be thinner in the body. So when there's low volatility, you'll see that there'll be a thinner probability, maybe a tighter probability, and fatter in the tails, which fits the stock return better. Users can type in probability instead of standard deviation to get the range. That's why like the standard deviation is kind of referring to a normal distribution, but we know that returns don't follow a normal distribution. And prices specifically don't follow a normal distribution. It's more so thinking about that log normal distribution that we started today's session with. Users can type in probability instead of standard deviation, get the range. We don't need a panel to tell you the probability according to the standard deviation. It uses an inverse cumulative distribution function to allow users to choose whatever probability input. The expected move is recommended over the original expected move because stock returns usually don't follow a normal distribution. The version is still under testing, only people with early access. So that center line, I definitely have some questions about, but yeah, this is I like this expected move a lot. It's incredible. I mean, it's very, very accurate. All right, so yeah, so Bitcoin, this is a new indicator to do, and that is a kind of a log normal moving average to kind of put it into perspective, but I still think that that's a terrible characterization of it. It's more showing you where things are in the distribution, but I still don't have a good grasp of the understanding behind it as well. But it is essentially showing you points where you would not want to be long, and then points where you would want to be long. And it's like the criteria for wanting to be long would be that the XEM is above the due, so that this blue line is above this step line, and that it's also blue, or whatever color you choose it to. You can see that over here it flashed. It went below the due in February or March of 20. And then over here in April of 20, it stays above the due and stays blue until May of 21. So just kind of looking at that, that's a damn good measure. And then kind of over here, you see that the XEM stays above the due. While it does turn red, it's still above the due. And then you can see how we're crossing below the due. So that's not a advantageous point to get long. And then then it's but it's still blue though, so that's a good sign. And then kind of looking at different measures like that. But I mean, there's so much to unpack really, and like Bali was saying today, like mutual information and things like that. Like there's like these indicators, they take so much time to code and stuff like that, and then we have people like myself that are just kind of skimming through descriptions, and it's just kind of it's not. I mean, it's if you really want to be serious about this, then I mean, put the time in, like and really understand what these things are, because people spend days and days and their lives kind of putting this into code and stuff like that, and just to be able to say, oh, the XEM's red or the XEM's below its due, but it's so much more than that, and that's really what I'm trying to be able to get to, be able to help explain. You might look at my candles and say, what the fuck's going on? How can you have green candles when there's negative returns? And this is entropy coded into the candles. So entropy is relatively low when the candles are green, and when the candles are black, entropy is relatively high. So this is entropy right here. So this is another way of measuring the amount of randomness that's present in the market. So you're looking at this indicator right here, and we can look at the description as well. But for a lot of people, they don't have it, but I know a lot of people do have it as well. So I'll definitely spend some time looking at that. So let's expect to move. And yeah, this shows like the team's level of understanding and stuff like that. But I don't even want to just looking at the description. In information theory, the entropy of a random variable is the average level of information, surprise, or uncertainty inherent in the variable's possible outcomes. The concept of information entropy was introduced by Claude Shannon in his 1948 paper, A Mathematical Theory of Communication, and sometimes called Shannon entropy in his honor. So Claude Shannon is I mean, he's incredibly well known, and I think that he has some type of he essentially invented the internet in some sense, but I'm not sure about that. I don't. This whole stream isn't for it's purely to kind of show the indicators and learn about the indicators, and then put them into practice. That's a big thing. So I sometimes get off track and shit like that. Sorry guys, but anyway, entropy concepts can be also used to quantify market efficiency. So how efficient a market is, saying okay, so is it following a random walk? So it's kind of like that variance ratio test, similar to that variance ratio test, and So we're looking at high entropy indicates that time series is random/efficient, while low entropy indicates that the time series is not random, and therefore the market is not efficient. So really efficient markets are hard to take advantage of because, well, they're really efficient, and it's really hard to trade something that's really random. If Thinking about that, I mean, if like you wouldn't want to trade something that's really random, because unless you were like long maybe, but still though, you'd rather trade in an inefficient market, in some sense. So since we know returns distributions are often skewed with high kurtosis, we use a mixture model to fit the data. This method accounts for the fat tails and the asymmetry of the distribution. So then this is kind of getting into the deeper parts of it. I don't know how many people have this, but this is just like a little bit of well, it's just a different way of looking at whether or not the market is random, essentially. and Jacob has over at Tastytrade. If you type in a Tastytrade, I mean, we can definitely do a deep dive on entropy as well. It's kind of like the surprise in your variable. So the amount of surprise, the amount of randomness, the efficiency. So the obtained density function gives us a better estimate of the occurrence probabilities than the standard distribution. When we get our occurrence probabilities, we then weight the odds according to our latest n observations specified in weighting period. After obtaining all the necessary parameters, we go on to calculating entropy. After obtaining our entropy, we use the interquartile range to detect when entropy is low relative to the past observations. We use the interquartile range because it is more robust metric that gets less significantly affected by outliers. So we can definitely go into deeper dives with more stuff, and feel free to go in the comments and kind of say, hey, that didn't really make sense, or can we spend some more time, and I'll definitely do that. But model estimation period specifies the number of bars used to calculate the mixture model, and weighting period specifies the number of bars used to weight the probability. And the filter determines the probability level that we want to calculate the entropy on. Filter of 95% calculates the entropy beyond the 95% probability threshold. So when things are really when we don't have a lot of confidence in where returns are, and similar to when we're looking at 2-year yields. So let's go back to 2-year yields, right? And we can go to US 2Y, and so then I make sure to, I'll show you guys. So I have for the past 100 periods. Let's go back to a 3-month. I don't think I'll be able to get an entropy value unless I go to some crazy low. So we'll go to a monthly. And then I want to see that on VRT. So what we'll do is what you can do is hit those 3 lines, hit the settings, save as default. And then I can go over here and I can throw up the entropy, or sorry about keep saying that. I can display entropy on here. And then this is on a 3-month, yep. So then we can see this on a monthly, right? And so what the VRT is saying is that returns are trending, and that that it's not following a random walk, and then entropy is saying that it's relatively inefficient, so it's relatively inefficient. So kind of seeing the difference in those indicators. I don't really have that much of a knowledge to be able to say the reason why it's a lower entropy. But that is interesting to see how the VRT and the entropy. I think maybe because I'm not sure. So, but anyway, so the VRT is the variance ratio test is testing returns for a random walk and trend in mean reversion, and entropy is testing for market efficiency. So then once you see that 72% drop, that the efficiency of the market for 2-year yields is going down. So you want to trade when entropy is decreasing, and the fundamental reason behind that is with the fact that the market is becoming inefficient. So that there's room to take advantage of that market, if you want to trade and stuff like that, as opposed to playing positive drift or whatever. And we have other metrics for that. But anyway, or BApig, sorry about that. And so yeah, looking at that. So that's kind of looking at entropy. So then the coloring of the bars is giving you a representation of where entropy is, and when the bars are green, I kind of made that like, okay, that means that entropy is relatively low, and that when the bars are black, that means that entropy is high, and you would not want to be trading because it's an efficient market. But I kind of messed around with the settings. I don't know if this is kosher or whatever, but I made the coloring period 5. So you're only going to be comparing based on the past 5 candles. So that's why you're going to see a lot of green. So if I put this to 100, right, then you're probably going to see a lot more black candles. And then what you can always do is you can undo, and you can see the difference. So you can redo, and then you can undo, and you can see how the difference is in how you want to observe things, I guess, on a historical basis. But yeah, that's a cool way of looking at things. So I kind of like the 5, to be honest, just to be able to see drops in entropy or increases in entropy. So right here, I would start to notice that there's something going on with entropy. I'm not going to say that I would start noticing it, but that would be a signal that entropy is starting to decrease. And yeah, you saw a little bit of a decrease, and then there's a larger decrease right here, and then there's the momentous decrease right there. And so just kind of looking at things with that lens, but I can't really say whether something's better or worse. But yeah, so right now entropy is low, so you'd want to be trading. Well, that's the problem, is that you look at one metric, and for something that's as complex as the financial markets, that one measure isn't going to be sufficient. That's why people with moving averages and stuff like that are sadly mistaken, and they think that the markets are something that they're not. Anyway, try not to go on tangents or anything like that. Just trying to communicate the indicators to you, and be able to see spots of noteworthy occurrences and things like that. All right, so yeah, let's check out natural gas maybe, or we can check out ETH too. But yeah, sorry about that. Fuck. I keep going off into random tickers and stuff like that. That's something that I do often. So this is Ethereum. It's outside of the 32% range and 32% monthly range, and you can see the center line at 7,000, and yeah, so there's so I mean, even right here, so we can go over and we can check things on like a weekly, right? And things look, so yeah. Oh, let's go back to a 7-day. So the difference between that and Bitcoin, that I mean, 7-day on Bitcoin, it's below its due, right? It's below its due, and yeah, and then comparing it to ETH is not below its due, and it's just kind of in a better spot in its distribution than Bitcoin. And then what's next? All right, let's go to the dollar, right? A lot of things trade against the dollar, so let's but I think even that is something that is a mischaracterization, that they trade, like they do trade against the dollar. But this measure right here isn't assets versus the dollar. This is other currencies versus, this is dollar futures right here. And this is so like the relative strength of the dollar, I guess. But what a lot of people reference is the DXY, and then they try to put some type of label on it because they're just trying to make the markets more simple than they actually are. And they're trying to say that if the DXY goes up, then assets will go down because they theoretically trade against the dollar, or they do trade against the dollar. But what they fail to understand is that the DXY is dollars, U.S. dollars versus foreign currencies. So against the euro and things like that. And what they don't even understand is that like they'll look at correlations and stuff like that. And they put all this weight on the DXY, and so what we can do is we can throw up a correlation if we want, but instead let's look at something even more next level. Let's look at mutual information, and mutual information is even better than a correlation. But we can still look at this right here, and we can say okay, we can look at correlation, and I can go off chart, and then we can go to Nasdaq, right? And a lot of people will be like, oh, the DXY is going up, or the DXY has positive returns, so the Nasdaq is going to have negative returns, which is if you want to look at whether or not the Nasdaq is going to have negative returns versus the dollar, then go to the Nasdaq's chart. Don't go to the DXY. The DXY is comparing the dollar versus the euro versus the Japanese yen. It's not comparing the dollar. That's just telling you the dollar's strength versus foreign currencies. So I don't understand how that would have any impact on Bitcoin or anything like that. But they say, oh, the dollar's getting stronger, and it's like, yeah, but it doesn't mean that. All right, so we're off chart right here, and correlation is telling us that there's insignificant. So that there's an insignificant correlation between, and you can see that right there is that, while the correlation is negative, the R squared isn't really high, and that the so and you look at your confidence interval. I mean, it's more it's towards -1 and stuff like that, but it's not. I mean, it's definitely not -1. It's -0.3. For a correlation, people look for like -0.8 or +0.8. But the correlation isn't the best measure, and we can go into it and we can say, okay, well, why isn't it the best measure? And let's go to the EEC. EEC. I mean, it's when so this indicator is showing the strength of the relationship between two variables. But what people are trying to use correlation for is they're trying to use correlation to essentially predict the outcome of another variable. So it's incredible because they don't even understand really what like the strength of the relationship between two variables. So how strong the relationship is between two variables. And so if things are positively correlated, that the strength right now is that they're positively correlated, but it's not telling you what they're using it for. What they're using it for as like a predictive measure, and they're saying, oh, so the correlation is something that's widely used in finance, but they're using it in a backward sense that doesn't really make too much sense. But sorry about the double right there. But anyway, so then we can go to mutual information, and that's really where it's at. And why is it really where it's at? We'll learn right now. So we'll go to mutual information. And then we'll read about the mutual information. So the correlation, from very brief explanation, is that it's the strength of the relationship. So how strong of a relationship we have right now. So and Bali's talked about this so many times, is that it's not telling you how you can predict another's movement based off of that measure. It's just telling you how strong our relationship is right now, or from historical data, right? But it's not giving you any predictive property. So it's like, that people are afraid that the dollar is going to gain strength against other currencies. It really doesn't have any predictive measure on other markets. So in probability theory and information theory, the mutual information of two random variables is a measure of the mutual dependence between the two variables. So think about the difference between how strong a relationship is and the mutual dependence of that of two variables. What would you rather know? How strong something is? So what's the level of just kind of the of two variables? What's the kind of looking at that correlation, or would you rather the mutual dependence? So how dependent is something on another? That's what you're really looking for, and I think that's just because correlation is something that's already been mathematically established, and few people know about mutual information, and it just goes back to like a lot of these people, like, they have no mathematical background, and they're just kind of going off of what other mathematicians and things like that have discovered, and it's just so that's why, looking at the math, you'd say, okay, so I mean, how strong a relationship is doesn't tell you what the dependence of one asset is to another. So it is something that's kind of it's flawed in just the math is obviously correct, but the way that they're using the math is incorrect, or just flawed. So more specifically, it quantifies the amount of information obtained about one random variable by observing another random variable. So you're looking at the dxy, and it's and you're trying to say, okay, so going back to this thought process by a lot of people, is that the dxy is going to is going to tell you what the Nasdaq is doing. That's flawed right there. Think about that. That people are using the dxy as a proxy for different assets because they're trying to oversimplify things. And so if I look at the dxy's chart, it will tell me what's going on with the Nasdaq. Well, maybe. We'll see. More specifically, it quantifies the amount of information obtained about one random variable by observing the other random variable. The concept of mutual information is intimately linked to that of entropy of a random variable. Going back to the efficiency or the randomness of a variable, a fundamental notion in information theory that quantifies the expected amount of information held in a random variable. The concept of mutual information is intimately linked to that of entropy of a random variable. A fundamental notion in information theory that quantifies the expected amount of information held in a random variable. The most used method to assess the dependence between two variables is Pearson's correlation coefficient. The dependence between two variables is Pearson's correlation coefficient. The downside of using this method to detect an association between assets is that it only accounts for the linear association between the variables, while the association between different assets can often be nonlinear. So thinking that the dependence is something that is like that can be expressed with a line, right? Like with a direct. If the dxy goes up by 5%, then the Nasdaq will go down by 5%. That linear relationship, right? But oftentimes they're not linear, right? So the correlation that you hear a lot of these prognosticators talking about, it's only accounting for linear relationships. Only accounting for linear relationships, but we know that in life and in financial, well, specifically the financial markets, that there are nonlinear relationships. So it's only taking into account that linear relationships, and we know that there's more than just linear relationships. So okay, keep going. The mutual information improves upon this concept by accounting for linear and nonlinear dependence, which makes it a better approximation for the degree of association and therefore also the amount of risk you are taking on by buying different assets. In order to obtain the mutual information, we first need to know the amount of information we need to describe each of the assets alone. So in order to obtain the mutual information, we first need to know the amount of information we need to describe each of the assets alone. So you're just looking at one asset. You're looking at the DXY and saying, how much information do we need to describe the DXY? Let's take assets A, DXY, and B, Nasdaq, for example. We will denote the entropy of the individual assets as HA and HB, and the joint entropy of the assets as HA, B, which tells us the amount of information we need to describe both assets together. So the amount of information that we need to describe, let's say, for instance, the DXY and the Nasdaq, right? In this case, where assets A and B are statistically independent, the following statement will be true. HA plus HB minus HA times HB equals 0, which means that we need the same amount of information to describe asset A and B individually as to describe the assets together, which results in the mutual information of 0. In this case, where assets A and B are statistically independent, the following statement will be true, which means, so HA plus HB minus HA times HB equals 0. So that means that there would be no mutual that means that there would be no mutual dependence. There would be no mutual information. Which means that we need the same amount of information to describe asset A and B individually as to describe the assets together. Which makes sense. Because you need to have all of asset A to describe, you need to have all of asset A, and you need to have all of asset B to describe both assets. So that would mean that looking at the DXY, there's no, you need to have all the Nasdaq's data as well. So there is no mutual information, as opposed to looking at the S&P and the VIX, that there is mutual information. Which results in the mutual information of 0. And in this case, where assets A and B are the same asset, the mutual information will be equal to the entropy of the asset. All right. So we can see HA, HB. So if you need to have all of HA and you need to have all of HB in order to describe the mutual information of HA and HB, or of both assets, then there is no mutual information. And perfectly associated variables, then you would have the information for HA describes the information of HB, and then the information of HA and B describe each other as well in that circle. So this would be more of like a Venn diagram or something like that, and that they overlap, but they only overlap when you have all of the information of both variables. And then in this diagram, they have that there's overlap, and you don't need to have HA to describe HB, and you don't need to have HB to describe HA, because they're mutually dependent. And then when there's no overlap at all, that's a 0 right there. So this would probably be like a low mutual information. So somewhere, I don't know, like less than 0.25 or something like that. But I'm not entirely sure about that. All right, settings and feature. The indicator includes 3 important metrics: normalized mutual information bounded by 0 and 1, information adjusted correlation, and the information adjusted beta, as well as the sample size. Due to different trading days, the sample size might be smaller than the period used in the settings. Calculation window specifies the look-back period for the mutual information calculation. Security specifies the security with which we calculate the measure of the association. Also defines the security that is treated as the market for the beta calculation. One can specifies the security with which we calculate the measure of association. It also defines the security that is treated as the market for the beta calculation. I'm not too familiar with the beta calculation and things like that, but one can specify the position of the table and adjust its colors and change the number of decimal places displayed. But anyway, mutual information being much better because it's describing nonlinear relationships, which we know in life there are nonlinear relationships, but specifically in finance that there are nonlinear relationships. So all these people on Bloomberg and Tastytrade and all this stuff talking about correlation, they should be talking about mutual information, but they just don't have the mathematical understanding. Yeah, it's just not in vogue in finance right now. But let me tell you that doing what everybody else does in finance doesn't get you paid. So, yeah, so we can go and we can say the DXY and how does that describe the Nasdaq, and let's see what we can ascertain by looking at the DXY. So you're looking at the DXY and you're trying to describe the Nasdaq. Think about that. You're looking at the DXY, which is a completely independent measure. You're looking at the dollar versus foreign currencies, and you're trying to describe nonlinear and linear relationships of the Nasdaq. You're trying to describe the Nasdaq with by looking at the DXY or Bitcoin. We can look at Bitcoin as well. So then we put in BTC USD, and the normalized mutual information is 0.05. This is a metric that's bounded by 0 and 1. So by looking at the DXY, you can describe 0.05. You can describe 0.5% of Bitcoin. That's what we're looking at. No. You can describe 0.05% of Bitcoin. That's literally nothing. You can describe, let's see the Nasdaq right here, all right, let's see, 0.03, even less. So looking at that, I mean, what is that telling you? We can look at it monthly, how much of it, 0.06, it moved up a little bit. But it's nothing. Like, it doesn't describe anything. So be careful of what. So now we can go to maybe the VIX. Maybe the VIX, it has some type of mutual information. So you can only describe 0.07 percent of the VIX. Like, you can describe less than 1% of the VIX. And then look at S&P, right? Yes. 0.06 on a monthly time frame. But on a quarterly, but let's look at the sample size though. I mean, maybe let's go to a 5-day, right? And let's make our sample size 1,000. Maybe I have to go to daily. So we got a sample size 1,000, right? And where are you? Show information. Yeah, sometimes you get those errors. It's just that it's taking too much data. But taking too long to execute. All right, so we'll go 500. Whatever. So for the past 500 candles describing S&Ps on a daily, yeah, you can have less than 1% of being able to describe, of being able to effectively predict the S&P 500 by looking at the DXY. So it's nothing. I mean, you can look at BTC or whatever, but if you look at a correlation, that's only describing the linear relationship, you know. But we know that there are nonlinear relationships. BTC, same thing, 0.03. You know, maybe for DeFi, maybe for some, let's see, DeFi. Actually, what I want to do is total excluding Bitcoin. Well, this is just the total market cap right here on a daily. That's how much you can describe that, you know. And then okay, so let's see what we can. Okay, so now let's go to the Nasdaq, right? And let's look at this right here, 5-day, and then let's look at ES. 0.3, significantly higher. So you can roughly describe 30% of the you can describe 30% of the S&P 500 by looking at the Nasdaq. And then let's say let's look at Nasdaq volatility. Let's see how that describes, or the relationship is 0.16. That's interesting. And let's look at BTC, because people always say, oh yeah, BTC and Nasdaq, it's like two tech related things. 0.02. 0.02, sample size of 400. Let's look at a daily. 0.05. I mean, what, 3-day? That'd be a good measure. Yeah, 0.02. Bitcoin and the Nasdaq are two entirely different things. Who would have thought? Why do you have to type in different tickers? Let's see something that's... All right, let's look at NVIDIA. 0.1. Yeah. So yeah, you can't really describe NVIDIA. And then other than that, yeah, let's look at something. Let's see something that's highly correlated. Let's look at all right, so we'll look at the US 30Y. Or see, that's the thing, that have high amounts of mutual information. I have to get that shit out of my head. Let's see that, and the US 2Y. See, like you have all these traders that are trading these spreads, and they think that they're hedged because they're shorting the 2-year and they're longing the 30-year, but they don't understand that they're completely independent markets. So let's see. Let's try to find something that has. Let's go to the market drivers. Oh, let's go to natural gas and oil. US 2Y. So then we'll go to CL, crude oil, and let's see what the mutual information is. 0.03. So yeah, you can't describe that. But let's do it on a higher time frame. Let's do it on a monthly. I think that yeah, see, even on the monthly, 0.04. I mean, it's very hard to find two assets that have high amounts of mutual information. Like think about it. Like that wouldn't make a lot of sense. And even like thinking about how you can look at one chart and then say, okay, now I'm gonna go blindly short another chart because of their linear relationship or whatever. And that's why mutual information is next level. Is definitely I mean, I want to hear one person talking about mutual information. Maybe it's Taleb, but damn sure didn't put it into code. All right, so now let's go to natural gas and the dollar. 0.04. Maybe we can try it on triple monthly. 0.11. Yeah, let's try ES in the VIX. .28. That's pretty. That is much higher than the correlations we've seen. 0.2. So let's try to find one that's high, and then we'll DXY in the euro. Yeah. Or the DX. Yeah, let's try GXY first. Or what we can do is we can just put in euro. How many years has this been trading for? 2003. That'll be enough. All right, so then we go over here, and then we can go over to DXY. 0.54. That's because the DXY, in the DXY calculation, there is the euro. So you can look at the euro's chart, and then you would be able to make some decisions, not all decisions, but you'd be able to interpret something of a fair amount of what's going on in the dollar. All right, now let's look at the DX, right? Same thing, 0.5, yeah. So that's something that I mean. That just shows like the level of you hear correlation all over financial media, and the thing is that it's so mistaken, and even if you asked what's the limit of correlation to 90% of portfolio managers, they wouldn't. I don't think that they would be able to tell you, but maybe they do. I don't know. But I don't want to make assumptions. I'm not trying to make assumptions here. I'm just trying to show you the difference between what's going on over in BApig land and what's going on over in Fin-ance land. But yeah, I mean, it's been a good stream. Sorry for stumbling. Sorry for doing some kind of just not being at my best here. But the only way that I can get to be my best is by repetition, and that's what I'm gonna try to keep up with. But hey, thanks a lot for listening through my stuttering and all that other stuff. And hey, keep after it, and we'll definitely get deeper into a lot of different